So here's some statistics that'll tell you how serious our debt problem is, because again, you have to, when you have debt, you have to pay your creditors interest rates, and that means the bill, as you borrow more and more money, you have a greater, increasingly larger interest payments to make to those creditors, and that comes at the expense of spending in other programs that are necessary, like Medicare, education, things like that, because there's only so much to go around, and if you're servicing debt with a lot of it, then there's not a whole lot left to do things that the country needs. So that's sort of the sobering thought, right, as to how all those things are going to balance out. So, so here's the cost of interest. So how much interest, because again, as you borrow more, trillions of dollars, there's also billions of dollars in interest payments that you have to pay out to satisfy those creditors. And so that's sort of the scary thought, is that obviously this will come at the expense of other things being cut. Domestic programs and other important programs that we depend on would be cut or compromised. So that's the bad thing. And then, of course, downgrading of U.S. credit. So part of the reason that, part of U.S. government's bonds have always been rated in the top category, because they were considered to be as good as cash, always, historically. Except now, for the first time, we are not a AAA rated bond. We are AA+, which means that you're one notch below the top. And that can come down further. The downside, and now you may ask, what's the big deal? I mean, what happens if you do come down in debt rating? Why is that such a big deal? The reason why it's such a big deal is because the interest rates that you can charge your creditors is a function of your rating. So if you are a highly rated issuer, let's say AAA, which is the best rating, then you can you have to pay the lowest interest rate possible. Okay. Now, as your rating goes down, the interest rate that you have to pay out to borrow money goes up. So it becomes more expensive to borrow. So that's why governments care about their rating. And so the US government was really annoyed when when S&P lowered its rating to AA+, because that would mean that extra bit of extra interest rates that the US government would have to pay out, that makes it even more expensive now to borrow than before. And as that rating, if it comes down further now, then that would jack up even further the interest rate that the US government will have to pay out for its bonds to its creditors. That increases the borrowing cost further and makes things much more expensive. So that exacerbates the problem that the US government is facing already. And that's why governments and entities care as to why, and want to maintain the best possible rating, because that lowers the borrowing cost. The higher, the better your rating, and that's the same way as us, and we individuals operate the same way with our banks. When we go to ask for money, let's say for a mortgage loan, whether or not we get that mortgage loan at the best possible rate is largely a function of our credit rating. The loan officer, when you apply to a bank for a mortgage loan, is going to do a credit check. They're going to run a credit check on you, look at your income, look at your existing debt, and so on and so forth, calculate a debt to equity, debt to income ratio, and then see how stretched you are. And if you are stretched, which means your risk is high, then you may not even get that loan. You may not be approved. Or if you are, it may not be at the best possible rate. So that would increase your borrowing cost. And so the governments operate the same way. Okay, so it's the same story, like I said, except it's a scale difference, right? So we operate in hundreds of thousands of dollars for mortgage loans and things. Governments operate in billions and trillions of dollars. But if you account for that scale difference, everything else works the same way. Okay, so that's why it's relevant. So the question is, why is this lowering of credit rating relevant? It's relevant because it increases borrowing costs for the US government when your rating goes down. So we talked about types of bonds, types of lending instruments or borrowing instruments. So the regular bonds, which essentially means that you lend money, or you lend money to an entity, whether it's corporations or governments or whatever, and then you get a periodic interest payment. And then when the bond matures, you get the face value back that you lent. That's basically how a regular bond operates. So callable bonds are the same as regular bonds, except that after X number of years, it's usually after 5 years, a bond can be called back by the issuing company, and the bondholder just paid off the face amount, the face value. Now, can you think of an example in real life where we use this idea of a callable bond in something that we do in terms of consumer transactions? It turns out that we apply it fairly regularly in our lives. Yes? Right, mortgage refinancing, exactly. Very nice, yes. We do this all the time. So what do we do? Let's think back on mortgage refinancing. What do we do? So let's say we take out a mortgage loan at a certain time in our lives, when whatever the interest rate is. Let's say for the purposes of this example, let's say we borrow at 5.5%. That was the best rate we got. We took a mortgage loan out at 5.5%. Let's say 5 years have gone by in your mortgage loan and interest rates have come down. Now the same mortgage that you took out 5 years ago at 5.5% interest is now being sold by banks for 4%, right? 4%, because interest rates have generally gone down. So what do? Your choice is, well, continue to pay 5.5% mortgage interest, whatever the monthly payments are, or do you switch to a new mortgage at a lower interest rate at 4%? And so what people do is they will apply for a new mortgage at that lower rate, and then, which is called refi or refinancing, and then use the proceeds to pay off the old mortgage. And basically you are saving interest rates. Of course, it's not as simple as that, because you have to still pay a couple of $1,000s to refinance that. It's not free. You have to close, and you have to, all these new fees that you have to pay. But for most part, it works out, because if you're planning on staying in your house for a few years, you can work out that difference, let's say in 18 to 24 months that you paid to refinance, and then the rest of the time you're paying a lower interest rate, lower monthly payments. So that calculation is fairly easily done, and you can figure out whether it makes sense to refinance. But refinancing is nothing but a callable bond in action. You're simply paying off your lender and borrowing again at a lower rate. And that's what companies do too. So if companies have issued, or governments have issued, well, governments usually don't. The federal government doesn't issue callable bonds, at least to my knowledge, but corporations do frequently. Corporations will issue bonds at a certain interest rate, and they have to have a callable feature on it, so that it's like an option. A company might exercise its option and call the bond back, and then reissue the bond at a lower interest rate, and thereby saving itself billions of dollars sometimes in extra interest costs that it saves by reissuing the bond at a lower rate. So callable bonds have that feature, and we use that a lot ourselves in our regular everyday lives. And then you have zero coupon bonds, which are nothing but zero coupon means there's no coupon payments on these things. You just simply buy a bond at a discount of the face value, and then when the bond matures, you get the face value back. So that difference between what you paid to buy the bond and the price you get at the face value that you get back after 6 months or a year, that difference is what your money earned over that period. So that's a zero coupon bond. Okay, so no coupon payments. You simply buy it at a discount to face, and then 6 months later or 9 months later or a year later, you simply get the face value back. That difference is your earning. And of course, there are these terminology. Par value for corporate bonds, par value is $1,000. It's the par value means just the face value of the bond Coupon rate, that's the interest payment. That usually is fixed, unless it's a variable rate bond, but fixed. Coupon rates are generally fixed for the life of that bond. And then maturity date, when does that bond mature? That means that period of lending is over, you get your face value back, and everything's done, and then it's over. And that's the fact that bonds have maturity dates makes valuing them pretty easy, relatively easy. Easier than stocks, where stocks do not, as I told you, do not have any finite maturity date. And of course, the interest rates and coupon rates are all fixed in bonds. So that makes the job of valuing bonds relatively easier than stocks. Okay, so we were talking about the way the federal government raises money by selling these treasury. T stands for treasury. Treasury bills, treasury notes, and treasury bonds. And the difference between those are simply a matter of timing. How long are these things good for? So T-bills have the shortest maturity. They're usually less than 12 months in maturity. So they're shorter term bills, extremely liquid contracts, very, very highly traded, and their maturity is usually less than a year. And again, those are sold as zero coupon bonds. So they're sold at a discount to face, and then when it matures, you get the face value back. And they're usually, T-bills have a face value of $10,000. So you might buy a particular T-bill, a 6-month T-bill for like $9,500, and then 6 months later, you get a check in the mail for $10,000. So that difference is what your money earns. So $500 over a 6-month period, something like that. So that's what your money will earn when you invest in a T-bill. It's not a whole lot of money, but understand that T-bills are extremely safe investments. Chances of your losing money on those are almost zero, except when two parties fight with each other and try to shut the government down. But that's more of a low likelihood event. Although they do happen, as we are living through one right now. Okay, so the 3-month interest rate that these T-bills provide is an important benchmark. So when researchers look for a proxy or a substitute for the risk-free rate, the 90-day T-bill rate is one of those interest rates is used as a proxy for the risk-free rate. Right, so that's actually used the world over, and that's another reason why U.S. Treasuries are so highly prized around the world. If something happens to the U.S. Treasury market, it'll have repercussions throughout the world because, for example, for one of the reasons being that the T-bill rate is used as a proxy for the risk-free rate all around the world. When people try to find something as a substitute to measure the risk-free rate of any investment, people use the 90-day T-bill rate as one of those measures. So it's used like as a benchmark, if you will, a lot. And then, of course, you have Treasury notes, which have between 1 and 10 years of maturity, pays interest semi-annually, twice a year. And then Treasury bonds, which are anywhere between 10 and 30 years in maturity. Okay, so those are so basically the difference, again, between those three is simply one of maturity. How long do they go on? Okay. All right. Why do they have to shut down everything when only a debate doesn't come to consensus? Sounds like, I agree with you. They're being childish, but understand that both parties, totally agree with you. People, you're preaching to the choir here because I totally agree. It's very childlike. But understand that these politicians have their own base constituency to please, right? So what may seem like strange behavior to us may not seem so strange to this politician who needs to get elected, right? Re-elected. And guess who's going to re-elect that person? Not you and I, but that person's constituents, right? And if constituents want their elected members to behave a certain way, then that's how they're going to behave, right? Because otherwise they're not going to get re-elected. So what seems like strange behavior to us and throwing tantrums and literally throwing rocks at each other across the aisle may not seem so strange when you consider that. Because each of these guys have been elected from their base constituency. And those people are the ones dictating, telling their congressman, this is what you do. And if he doesn't do that, he or she doesn't do that, then chances of getting reelected are slim to none. And that's why these people do what they do, which seems strange to anybody else, but not so strange when you put it in that context.
What are the disadvantages of buying a bond?
What are the disadvantages of buying a bond to the buyer? What are the disadvantages of being a bondholder? A good question, a very good question. So what are the disadvantages? So let's think about it. Disadvantage is probably a strong term to use, but understand that bonds are fixed income securities, right? So the upside to bond investments limited. Unlike a stock investment where upside is unlimited, if a stock can go literally from $2 a share to $500 a share, right? I mean, it does happen. Doesn't happen all that often, but it does happen. Google's and Apple and all those companies, if you look back, that's what, Apple was trading at less than $3 a share in 1997, but things are looking really bleak for them, and now they're like upwards of whatever, $500-600 a share. Maybe a little less right now because they haven't been having such a good time, but you get the picture. Whereas with bonds, your upside is limited. And well, the counter to that is that it's also less risky, right? So less risk, less return. So when you invest in bonds, understand that that's the game you're getting into. Less risk, less return. And if you're comfortable with that as an investment strategy, that your risk taking abilities are constrained and you're comfortable not taking risks or not taking a whole lot of risk, then bonds may be a good thing to have in your portfolio. Okay, not all of it, but at least some of your money can be in bonds very easily because it gives you that safety net. So that's sort of something to keep in mind. Okay, we are done. So the correct answer is D with 71%.
And then it just got shut down and exempt.
Okay, all right. All right. That was a trick question, wasn't it? A little bit of a trick question. All right. So yields. Yields is like calculating returns on stocks, right? So yield, how much does your investment yield? That's, at the end of the day, that's what we want to know. We put money in, whatever it is we are investing our money in. We want to know how much income our money generated. So for bonds, that's calculating the yield of a bond. How much did your investment yield? And yield here is the coupon payment that you get divided by the price. Now, if you and so yield is a sort of a rough measure of return. If you really want to be precise, more precise, it's yield to maturity is a better measure. Now, it is relatively complicated to calculate yield to maturity, but happily, all of Excel, our savior spreadsheet, now can do this for you automatically. You just put in, it has these built-in functions, and you can actually calculate yield to maturity. It requires a couple of parameters that you feed it to in the formula, and it'll just compute the yield to maturity for you. And the reason why it's complicated is simply because it is a nonlinear equation. It's very much, it's fairly difficult to solve by hand, and therefore you have a macro written for it by Excel that you can actually use. So most people just plug it in an Excel spreadsheet and calculate the yield to maturity. And here's what the definition is, what you're getting with yield to maturity. Okay, well, this is just gives you an idea of treasury yield curve rates. So these rates change on a daily basis, all right? I was telling Maria that a graph would have been much more illustrative of what's going on, but these are just numbers that'll tell you. So maturity on top, and then daily rates, how they change. They change, from day to day, as you can see, and the longer the horizon, the higher the rate, which means it's an upward sloping yield curve, which is pretty much what you see. Yield curves are upward sloping. So you have maturity, time to maturity on that one hand, and then you have the dates, and you can see that as you go out in space, longer periods generate higher returns. Longer term loans generate higher returns, which is what you would expect. Why? Because longer term loans means the risk becomes higher. Chances of things getting wrong, of something going wrong, increases, i.e. the risk increases, and therefore when you have a longer term loan, you would expect higher returns. Okay, so I'm gonna, how do you make money holding? That's the age-old question, right? How do you make money from bond holdings in bonds? Now in stocks, it's relatively easy to see. You buy it at a certain price. When prices go up, you make money. Prices don't, you don't. So so how do you do the same? What's the corresponding rule in bonds? Well, it's pretty much the same. You buy it for a certain price, and if the price goes up of that bond, you make money, and if it doesn't, you don't. So really, the rules are the same. The question is, what drives bond prices? And the answer is interest rates. There's inversely related, bond prices are inversely related to interest rates. When interest rates go down, bond prices go up. When interest rates go up, bond prices go down. And what do we mean by interest rates? Prevailing interest rates in the economy. Okay, prevailing interest. So right now, given the environment we are in, the Federal Reserve has really, really lowered interest rates to almost zero borrowing rates. Therefore, bonds are not considered to be a very good investment in the current environment because interest rates are so low to begin with. So as an investor, your chances of making money in the bond markets are pretty dismal. Okay, so the important thing to remember is that bond prices and interest rates are inversely related. Okay, and then of course, bond ratings are very important. As I told you, when they're AAA, that's the best. You always want to be AAA because that minimizes your borrowing cost. When you are considered to be AAA, that means your risk is considered to be minimal. That means you have to pay out to your creditors the lowest possible amount, basically the risk-free rate. Which is good because every time your risk goes up, your borrowing cost goes up as well. Now you have to pay more to your creditors. And then, of course, the other benchmark to keep in mind is this junk bonds that are called junk bonds. Junk bond is a catchy name that was coined by, this is way before your time. Okay, your parents would know this. You can run this name by them to see if it rings a bell. A guy called Mike Milken, very well-known bond trader of Salomon Brothers in the 80s, coined this term, junk bonds, and that term still exists today. These are below investment grade bonds. Okay, so anything that has a rating of BB plus or below is considered junk bond. And junk bonds are speculative bonds. So these are, in stock world, if you want to find a parallel to stocks, these are like penny stocks. These are like these pink slip stocks that we sort of referred to when we were talking about stocks. The high risk stocks that are traded in the basement of NASDAQ. Those are the kind of, so the equivalent of that in bonds are these junk bonds, speculative bonds. These are they trade in pennies, very, very low price, but high risk. So there's a lot of trading in those because there are a lot of risk-taking people who trade those speculative bonds. Okay, and then we talked about why is it important. You should have the answer now. Why is it important to maintain high bond ratings? Right? Because it lowers your borrowing cost. When your bond ratings go down, borrowing cost goes up. All right. So a bond rating example. So here's Ford Motor Company, F. And so there's a bond. So companies will frequently have a lot of bonds outstanding because a lot of times bonds are the way to raise cheap capital because you're not giving away ownership, right? You want to borrow money and because you need money to open a new plant or improve your technology, manufacturing technology, whatever, and you need money for that. But if you sell stocks, problem is you're inviting new shareholders who will then tell you what to do, and that a lot of people don't want to hear. A lot of management staff people don't want to hear. So, and especially when borrowing is cheap. So this company that I've been dealing with the last 6 or 7 years, a large oil services manufacturing company in the Fortune 100, they have historically never used debt. Never used debt, okay? Never used sold bonds, nothing. Very, very cash heavy company, extremely well profitable, et cetera, as most oil related companies are in this country. But even they recently have started raising money through bonds because it's so cheap. The CFO told me, why not? It's almost free money, we should do it. And so they've been raising billions of dollars through bonds, only because it's so cheap now to raise money through bonds. Interest rates are so low. But so companies use this as a way to raise money, and so Ford is no exception. And you can see all these different bonds that they have. So you can see the maturity dates when these respective bonds will mature, and then how much they have raised through each of them. Credit quality is the middle. So they're obviously not AAA, clearly not. This company was on the verge of bankruptcy not too long ago, as you remember. They were bailed out by the federal government and so on. So the price, these are in units of 1,000, and the coupon rates are more important. You can see how much they're paying out in interest rates. And of course, coupon type is fixed, so these are fixed interest bonds that they've issued. They're not, so as you can see, callable, none of these are callable bonds, no. And then of course the yield to maturity has been computed for you. So this just gives you an idea. The moral of the story here is just to show you that all these companies have different kinds of bonds simultaneously outstanding at any given time. And they continuously, so a lot of these will mature at a certain point, drop out, and then new bonds will take their place, new borrowing instruments. So, okay, so we figured out how do you make money in bonds. We've talked about now bond trading strategies. What are some of those trading strategies? Well, you can one of the most important ways to trade bonds is this idea of laddering. Laddering, okay, so I don't know, we talk about laddering? Yes, I do talk about laddering, so I'll hold off on that till I get there. But so depending on whether you are trading, okay, so a lot of times what people do, people and companies do, let's say you have a lot of cash, for whatever reason been paid, you've got bills paid, your suppliers or whatever, your customers have paid you, and you've got a ton of cash in your balance sheet. Companies have a lot of, if you have a lot of cash in your balance sheet, which is just sitting there, it's not a good thing for companies. And the reason is a lot of money, cash sitting on a balance sheet attracts attention of company. You become a takeover target when you have a ton of cash sitting in your balance sheet. You attract predatory attention on your company. Okay, so companies don't want to be targets, right? You don't want to be eaten, gobbled up by, not always at least, by a bigger company. So what companies do is usually when they have a lot of cash, they want to park it somewhere. They want to park it somewhere in the short run. And one way to do it is to buy short-term bonds, treasury bills, treasury notes, because you can park your money, generate some interest, a little bit of interest, it's safe, and it's out of your balance sheet, and it's invested in bonds. So companies will invest a lot in these kind of, and individuals, we do that too. If you look closely at your bank accounts, a lot of times you can do what is called a money market account. I don't know if you've heard that term. Sometimes your bank person will tell you, oh, there's this money market account you can put. Money market account is nothing but short-term bonds, okay? Short-term bonds. And money market, and you have to have like a minimum amount in order to qualify for being in a money market account. But money market is something that we individuals have access to through our banks, and those are nothing but investing in short-term bonds. We may not realize it, but that's what they're doing. That's what they're doing. So you can do a mixed strategy with bond trading strategy, specifically with mixing up the short-term to long-term bonds. And so when you mix that up, it sort of protects you from wild fluctuations in prices and yields. So if things tank in the economy and you have a mixture of short and long-term bonds in your portfolio, that will smooth over your returns. So it's what's called income smoothing or return smoothing behavior. Laddering is another very well-used strategy where you are in your bond portfolio mixing up bonds, similar bonds of different maturities. So similar bonds, similar risk, but one having a 10-year maturity, 9-year maturity, 8-year maturity, 7-year, 6, 5, 4, 3, 2, 1, and you combine them all together so that next year the 10-year one will mature and then you'll replace it with another one. And so this laddering strategy, again, does the same thing. It provides you with income smoothing or return smoothing behavior. So, in investments, you often hear the term dollar cost averaging. So this is like return averaging. You're averaging across different yields. And so therefore, if there is a particularly rocky year or 2 years, you're not going to feel, your portfolio is not going to feel anything because it's going to be averaged out over these 10, 11, 12 different maturity bonds. And therefore, you won't feel that kind of fluctuation. That's why people do these laddering strategies. Okay, so here is an example of that laddering strategy. So, as a matter of fact, 10-year T-bond issued in 2000 yielded 6.8%. So that was the going rate at that point in time. But a 10-year T-bond issued in subsequent years was yielding considerably less. So the interest rate climate had become less favorable for investors, and the interest rates had gone down. And so you would observe a better return on the bond issued in 2000 rather than a similar bond issued in, say, 2005. Right? So, because the yield would be much lower in those cases. So laddering, if you were to combine the 2000 yield bond with the 2001, 2002, 3, 4, all 10-year bonds, but collect them together, then your average yield over this period would be a smoother number. It won't be fluctuating as wildly. And that's the advantage of combining them in a laddering strategy. Okay, so it smooths out your average yield. Okie dokie. Can you choose to deny bond annuities so that the interest could be compounded and you could receive a higher payout? Choose to deny. No, you cannot deny. You cannot just say, I won't take the money. No, you're contractually. Now, what you can do is you can then put it in an account somewhere and then compound it yourself. You can do it yourself if you cannot tell the company that you won't take the money because money is contractually given to you and the company will simply want to give it to you. But you can do it yourself. And a lot of, you can see ads of companies that will do that for you for a fee. And I don't think it's worth it, but there are companies that will do it.
Where can I buy corporate bonds?
Where can you buy corporate? Call up your regular dealer, the one you buy stocks from, dealers, and they will find it for you and call up. It's a telephone market, so you don't do the telephoning. You talk to the brokers who then will talk to their bond dealers and get in and sell you bonds. So essentially it's the same. You do not have it online as conveniently as stock trading. You simply talk to a local brokerage firm like Merrill Lynch. They have offices here and other brokerage firms, and they will get in touch and they will talk to you and get you connected with the right person who will then do the transaction for you.
And what is the Rule 144A?
Rule 144A, I'm drawing a blank right now. I'll have to look that up for you. I don't. Oh, there you go. Yes. Okay, there you go. So it's a rule modifying a 2-year holding period requirement on privately placed securities. Okay. All right. So Maria, you can provide that link.
Okay. And
Okay.
what does the price physically mean?
What does the bond price physically mean? Price of a bond. How much money you pay to buy the bond. That's it. It's the price. That's the cost. That's the price. That's the tag. That's the price tag. That's what you pay to buy it.
That's it.
Okay. 84%. All right. So the difference between debt and equity. I mean, we sort of talked about it already, but I just wanted to sort of summarize the discussion. Bonds, obviously, not an ownership instrument. They're a lending instrument. So you're a creditor, not an owner. When you buy a bond, as a creditor, you do not have voting rights. As an owner, with the stock, you have voting rights. Interest is so when you're a bondholder, you earn interest, coupon payments, right? And it's tax deductible. Dividends are not considered a cost and are not tax deductible. So when you get dividends, that's income. That's straight income. Creditors have legal recourse, and this is the key part: is that creditors have a lot of flex, a lot of muscle. A lot of muscle when it comes to companies. When you're a creditor, and if the company misses a coupon payment, you as a creditor can take that company to bankruptcy court immediately. It doesn't matter. I mean, you have the right to take that company into bankruptcy court if they miss a credit payment, if monthly payment or coupon payment. So that's something that as a creditor you have the right to, and that's what gives you, and you are ahead in line. So if a company that you are a creditor to goes bankrupt for whatever reason, as a creditor you stand ahead in line in front of stockholders. So stockholders are what is called residual claimants. Residual claimants. So after everybody's been paid off, if there's money left, then stockholders get paid, which in most cases is zero. You get paid nothing because nothing's left. So, so creditors have a safer deal because they are ahead in line. The chance of them getting most of their money back is pretty high. So excess debt can lead to financial distress and bankruptcy and stuff. So it's one's an ownership instrument, the other's a lending instrument. So that's the difference, and everything else flows from there. All right. So there's advantages and disadvantages to either, and you have to be clear about that when you get in on these investments. So here's a graphic and just simply gives you years in which stocks did better than bonds in the overall market, and years in which bonds did better. And just taking a quick look will tell you that years that stocks did better than bonds is significantly more. You can see that the left-hand side is more frequently more populated than the right-hand side, relatively, somewhat more. So what do we learn from this picture? We learned that stocks do better. Stocks have better years than bonds in most cases. If you go back over the last last 30 plus years, 40 years, you'll see that stocks did. So the chances that stock will do better than bonds in a given year is higher. Okay, so stocks are where the action is basically where likely to be where the action is. Bonds do well. I mean, of course, bonds are traded a lot. There are people, bond traders, and people use bonds as part of their strategy with stocks, mix them up and stuff to sort of temper the risk of the overall portfolio. So this is something that I'm not going to spend a whole lot of time over because you can read this. There's an extensive discussion in the book about this bond. The purpose of this example was to show you that bonds are not always boring. You can make them exciting, i.e. risky. And so this Orange County is this county in California that we've all made famous by a TV show, but it's the same Orange County that actually in December '94 went bankrupt as a county. It filed for bankruptcy, which at that point was fairly unusual. You didn't hear of local governments going bankrupt, but this one did. And a big part of that was the bond trading strategy that the county treasurer at that point was indulging in to boost revenues for his county. Because every state government needs money. Every state government needs money. Local governments, city governments, they need money to do, pay the garbage collector, to do all the basic infrastructure stuff, to pay state employees. You need to have an income source. California was one of those states that passed legislation just before that limiting property taxes. The property tax is a big source of income for all, including our own here in Tippecanoe County. So And so, but if you limit how much money you can make from property taxes, as most counties by now have done, including us, so what do? So when you're a county treasurer and you have to pay these bills and you cannot, your source of income is drying up or limited, what do? So this guy thought of what he thought was a brilliant idea. He decided to trade in bonds and to indulge in certain fairly risky bond trading strategy. And I'm just going to give you the sort of the highlight of this. He leveraged, it's a leveraging strategy. What he did was he leveraged his bond investments. And you remember the leveraging example I gave you, is that when things go well, leveraging amps up your returns in a positive direction. When things don't go your way, it also amps up your losses in a bad way. So what he did was this repo strategy, repurchase strategy, and which I'll let you read, and it's fairly easy read. So, but what he did, bottom line, was he did these bond leveraging strategy. He carried out this leveraging strategy where he essentially multiplied, magnified. If things go well, it boosted his returns 5 times. And also on the negative side, if he didn't bet in the wrong, if things went the wrong way for him, then he would lose money in the same level. So it amped up his strategy both ways, but by a factor of 5. Most people didn't know at the time what he was doing, but for the most part, when he started doing this stuff, he was betting in the right direction. Interest rates were going down or staying the same, and he essentially made a ton of money for his county. And so when the money was coming in and things were going right, he was a hero. He was, people would think of taking out statues for him. So because the surrounding counties were hemorrhaging money, and here was Orange County that was could afford things, and they were looking flush, they had a lot of money, flush with cash. Things were great, and the treasurer was a hero. Then it didn't last very long. A few years later, when the interest rates started going back up, he was on the wrong side of that, and obviously his losses got magnified as well, which is standard thing with leveraging, as you know by now. And so here's an example of what a repo is. I'm going to 5 to 1. So for a while the strategy worked, and he was on the right side of his betting, and the county was making money, a lot of money. The investment pool, when things are going well, was earning 8.5%, while the state of California as a whole was earning roughly half of that. And that, when you multiply that by hundreds of thousands, millions of dollars, that is a significant difference in return. So the county was making a lot more money, Orange County, than any other county in California, the state of California. And so Bob was a hero. People didn't quite understand what he was doing, but as long as he was bringing in money, everybody loves a winner, right? As long as you're a winner, you're winning games, winning money, bringing money in for the county, you're a hero. So he was a hero. Then a few years in ~94, the Fed started, and the center point of his strategy was for interest rates to stay low or not go up. As long as interest rates stayed low, his portfolio was bringing in that kind of money. But then in '94, the Federal Reserve started raising interest rates. And that was the beginning of the end for him. So since 1989, so 5 years went by, and he was doing really great for those 5 years. And he, for some reason, didn't see this coming and was short-sighted or blind-sided by the fact that suddenly the Fed started raising interest rates, which meant that he was suddenly on the wrong side of that bet and that he was losing money now. And so then the value of his portfolio started going down, and then eventually the treasurer resigned, the county filed for bankruptcy, and by liquidating, the county locked in a paper loss of $1.6 billion, which for a state county, is a lot of money. However, the caveat to this, or the footnote to this, is that right after that, interest rates again went down. But of course, at that point, when the county liquidated, they just panicked. The county just panicked, and they just sort of locked in that loss. But here's the story. So this is what tells you that hindsight is always 20/20 in investments. So if the county had not filed for bankruptcy and not panicked, they would have recouped most of their money. They would have only had about a $200,000 loss or $200 million loss rather than or 1.4 versus 1.6. They would have recovered 1.4 billion of the 1.6 billion losses, right? So they would recovered a majority of that loss, But hindsight is 2020, right? We at that point just people didn't want to do anything with it. The constituents all panicked. People just panicked and they just locked in that loss. All right. We'll stop here today.